Usually I start out the podcast by saying good morning, but it's anything but a morning. Putin did it. He invaded Russia. Russia invaded the Ukraine. He pulled the trigger last night. It was about 11 o'clock. News started reporting about airstrikes coming in. Looks like there's boots on the ground now. They've shut down a large portion of airports. Air travel in the area is shut down. And probably the worst that could happen just happened within the last 15 minutes, which was China came out and refused to call it an invasion and blame the U.S. In my mind, and I think in a lot of other people's minds, that opens up the potential for something where China is aligned with Russia. They don't want to say that they completely condone the invasion, but they also don't want to come out against it because, remember, Taiwan is the tipping point. And the last 3 administrations have all called Taiwan and the independence of Taiwan as the most dangerous portion of the world. Outside of North Korea launching some type of nuclear attack, or some type of major escalation over with North Korea, the Taiwanese independence from China has been considered just an enormous tipping point. So when you have Russia invading Ukraine at this point, and I'm not a policy expert, I don't expect to know everything about this stuff. What I do know is that the Russian stock market just lost. They shut it down for the day. It just lost 35%. Overnight, the market went down 35%. The Russian ruble is in just almost worthless at this point. Ukraine has shut down their banks and limited withdrawals. If you look at the roads out of the major cities, they are in just transit purgatory, meaning that traffic is just at a standstill. So here's what you're seeing in the market. Oils are going up. Oils are flying. And remember, our plays with Devon Energy and Fang Diamondback, they're up enormous this morning. These are things that that you could have predicted, you knew was going to happen. So getting into energy was a smart play. What's bad are the technology and essentially the Palo Alto networks that we got into. I got out with a 7-8% profit. It might have been 5%. But as I started seeing it go down yesterday, I said, okay, I'm taking my profit and moving on. Lowe's, Home Depot, that they beat, all of these stocks, they're opening down. Here's my suggestion for today. I'm not going to give specific stock advice. I know that yesterday I said, hey, Moderna could fly on earnings. Moderna's not flying today, even though they reported a record quarter. I think it's down by 2%. It is being brought down by the entire stock market. My guidance to everyone out there listening is, and Joe Terranova on CNBC just said this, and I thought it was perfect, absolutely perfect. He said, this is your grandparents' stock market. This is the market that everybody's grandparents hoped for when they were investing for generational change. Apple, Google, Microsoft, they're significantly down from their all-time highs. These are companies with great earnings that are going to trade at significant discounts. Now, here's the caveat to this, and I saw this. Stephanie Rule put it out on Twitter this morning. I think it was Stephanie. She put it out. The S&P has traded at 19 times earning. That's what it was yesterday. I think today it's going to be closer to 18, but it's at 19. It still should be around 19, even though we are significantly down on the futures. The traditional S&P multiple is 17. So we still have room to go down. There's still a significant amount that you could go down. What I think you should do is start treating this like your grandparents did with IBM and GE and the Nifty 50 of the 70s and all of those types of things. companies that you see that are going into the future, short future, if your time horizon is 3 to 5 years, I want you in tech. If your time horizon is 6 months to 8 months, I want you in energy. I want you in financials. You're going to see great opportunities to buy these things. If your time horizon is 1 to 2 years, I want you in Pepsi. I want you in Coke. I want you in things that are going to be able to price inflation in. There's a significant increase in all of the commodity prices today, and you're seeing this now. Oil and energy still have room to run. If Russia were to halt their exports of oil, they could cripple the economies of the world, essentially, if they wanted to. I don't know if they want to. I don't know what Putin's end game is on this one. He's seeing 30% of his entire country is now, the value of his country is now gone. Will that come back? Who knows? There's going to be significant sanctions that are announced today by the West. There's a emergency G7 meeting. This isn't the time to get out. If you have some tax advantaged accounts, I would say, time to rebalance. This is just like 2007, 2008. It's just like the others. What we've seen in the past has been a 2020 with the virus. You saw a big V-shaped recovery. You will not see that big V-shaped recovery right away on this. If you remember, it was way down in March. And then in April, it went a little bit further down for the first couple of weeks, and you started to see a slow recovery. We weren't back to the levels that we saw in February until October, I think. Let's take a look at the SPY if we could. And we'll do a weekly to try and see where we were with SPY on this one. Let's look. Because 2020 is the most recent. And if you look at this spike, we were at, prior to it, 336 on SPY. We didn't get back there until August. So you've got a 6-month delay, a recovery. If this were, again, we're in February now. You're looking at July or August to try and recover. The difference is what you've got in this. Interest rates were going down during that time. Inflation was fairly non-existent during that time. You've got rising inflation. You've got rising gas costs. You've got, remember, oil went negative during this time, whereas, companies had to pay people to take their barrels of oil. This time you've got a crazy inflationary pressure. You've got rising interest rates because, sorry, but Jerome Powell's going to have to raise interest rates on this one. There's no doubt about it. So you've got continued pressure. My suggestion is definitely nibble on your Apple, Google, and Microsoft. I don't think it's time to get out of these names because when do you really get back in? We could see several days of V-shaped recoveries where you go up. But today with these averages down 3-4%, I think you start nibbling on those. Any company that does not make money, sell, get out. Just don't be in there. If it's got a negative balance sheet, the only caveat to that I would say is cybersecurity, like Palo Alto Networks. I think that's a great one to try and get into, especially at these prices. You're seeing it, down after its earnings. It had record earnings, but you're seeing, Norwegian Cruise Line down 10%. Chevron is up 4%. Again, Chevron returns value to the shareholder. American Express, which I said yesterday I wanted to get into, it's down another 5% today. You're going to see international travel even limited on this one. You're going to see, a major kind of turn on this. When you look at the SPY and you look at the RSI, it's at 38. Last time it was at 38 was 2020. It hasn't been down this low. This presents a buying opportunity. That's why you have cash on the sidelines. It's for days like today. You basically should have been selling into the rallies and buying on days like today. So my suggestion for today, again, I'm not suggesting specific stocks, but take a look at some of the stocks. If we look at Apple, let's take a look at Apple. You've got Apple opening up at 153. Let's take a look at Apple on TrendSpider. I was in Active Trader Pro. Apple at 153, you're back to where you were in January of this year or December of 2021. If we hit the 150 level, so we go down below the 1.5 handle and we go down to the 140s, you're way back to August 2021. If we go back, let's look at a weekly chart of this one. Apple, again, if I think it's going back to 2020, you could go back to August of 2020 where it hit 127. I don't see a lot of support around there. I do see, if I go back to that August 31st where it hit a high of 160, and then it kind of pulled back there, and even today it went up to, I think the high was 52-week high on Apple, 182. So you've been trading in this range since September 2020, which is the 160 to the 180 kind of realm. It hasn't moved a lot. It's been using the 50-day on a weekly chart as its support level where it's bounced off of. It's still not down there. The 50 days at 150. I totally expect it to hit that at some point in time today. It's going to open up at 153. It'll probably hit 150. If we get below that, it looks like the volume shelf is around 133. Will you be unhappy 5 years from now that you bought this at 150 instead of 133? No, you won't even notice. Again, this is one of those times where you want to make sure that you're nibbling on these. I wouldn't, say you have a $10,000 buy on Apple. I would buy $1,000 of it today. I would buy 10% of it at what you maybe 150. Put it in at 150. And then tomorrow, if it goes down to 140, you buy another 10%, buy another $1,000 at 140. I think this is your opportunity. And again, Coke and Pepsi, some of the other names. Let's look at some of the other names that I was looking at yesterday. Ironically, I was looking at GLP Global Partners, the more energy names. I was looking at putting more money into that, but I've got the Devon, I've got the FANG, I've got Exxon. So I do have some energy positions in my portfolio. Unfortunately, I don't have the XLE and other kind of ETFs. I have significant other ETFs that are going to be down. But let's look at my portfolio a little bit. Bitcoin's going to be down. Ethereum's going to be down. The crypto's trading kind of like the NASDAQ. It's just going to be torn up today. MPLX, great company. Let's look at their dividend. They are an energy company. They are going to open up slightly down, not significantly down. This is one that has an 8.99% dividend. Let's take a look at their weekly chart on TrendSpider. MPLX I have owned for a good while. It's using the 200-day. It looks like it just bounced off the 200-day. If we run the algorithm, we wouldn't be in it, but it looks like it might cross up. It's been oversold of recent because of the dividend payment. Looks like it's been coming down from about 32, 33. We had a sellout here. We had a buy-in. It looks like December 17th at $28. And then you sold out at $32 on February 18th. And that was where it kind of bottomed out on the RSI. And the RSI looks like it probably will pop back up. If we look at the stochastics, I'm going to add in the stochastics act faster than the RSI. But yes, I see the stochastics. They're kind of crossing up, and I think this one, opportunity again, energy, get into it. I like that name. Exxon, I think Chevron, Exxon, I think you could get into those even though they're up at 2-3% today. With oil just jumping over $100 a barrel, I think you've got an opportunity to get into those as well. Because again, I don't think oil's done going up. I think we're going to continue to see inflationary pressure. My hope is that Biden kind of loosens some of the controls on this country's oil rigs. I'm an environmentalist. I hate to say that, but I think that would be the best opportunity, is to try and make sure that we can pump and we can make sure that we get through this. Again, oil isn't like a faucet where you can turn it on and then it comes out of the ground. They have to ratchet things up. My guess is that the Saudis will probably increase some drilling to do this. But again, I think this is one of those major events where you're going to see a bounce back from it. You're seeing, I think the SPY, in my mind, if I were to look at SPY, let's take a look at some of the support levels on SPY if we could. SPY is just oversold. The RSI is at 29. It hasn't been this oversold in quite a while. Let's look at the weekly on SPY because we just crossed the 50-day. We're nowhere near the 200-day. The 200-day is right around 340. So you've still, on the weekly, you've still got a long way to go to get down. The last time we crossed the 200-day was March of 2020, March 23rd, 2020. That was the week where we kind of, it significantly came down, but you're seeing it shoot up. The 50-day, we just crossed it. The last time we crossed under the 50-day was March 2nd. And we saw that bounce up. So when you're looking at this, I'll post these as well on the Twitter and the Medium blog so you can see it. I don't think it's time for panic yet. This is something that's probably going to hurt, and we probably will not see the 1 week bounce back up. My guess is if you're looking at 2020 as a guide, you're seeing to 6 to 8 months out. And Tom Lee said it best yesterday, is that the front half of this year is going to be trash. But the back half should be a positive. So you're looking at 6 to 8 months of recovery. In the meantime, I would get into some of those defensive names. Again, Apple, Google, Microsoft offer great opportunities here. Pepsi and Coke are great hedges against these things while getting a dividend. Some of the travel names, American Express, financial. It's gonna, it's one of the recovery plays. I think that's a great play. If you look at the XLF, let's just look at the financial XLF. And let's take a look at the weekly too. Actually, take a look at the daily. We'll take a look at the daily. The daily is just crossing the 200. So it hasn't had a death cross. Let's look at the weekly to see if we can see if there's a death cross or anything on these charts. Again, remember, charts just tell us a story of mathematics. It doesn't have catalysts like the invasion of Ukraine, like inflation and raising of rates. It just tells us that you've got to take charts with a grain of salt. But you are trading towards the 50-day. The 200-day is still significantly, and this is on the XLF. XLF 50-day is at 37.78. Today we're trading at 38.34. The 200-day is down near 29, and this is on a weekly chart. XLF has been significantly oversold. It is down near 49. 48 on the RSI on the weekly chart. And let's look at the XLE. If we look at the XLE on a weekly chart, you are just now, the 50-day is crossing up on the 200-day. Your RSI is at 66, so you're significantly overbought. The MACDs are high up there. But again, I think historically you are looking at XLE when you look at the weekly. You're still looking at it down. When you go back to 2014, the XLE was at 100. You're what, 60% of that? So you still got a 40% move up if you're looking at this. So traditionally, I don't think this is a bad play. Even though you've, again, back in October of 2020, you were selling at 29.30. So within a year, you've doubled. on an XLE. This is an ETF of energy that doesn't move like that, but you've probably still got 40% on the upside. Again, there's opportunities out there. Today's going to be an ugly day for your portfolio, but remember, your portfolio should consist of 40, 40, and 20. 40% is your long term. You don't touch it. In my long term, I've got Apple, I've got Microsoft, I've got Google. Those are significant ones where I just don't touch them. They kind of stay there. The ARK funds have been in there. Unfortunately, I think I'm moving the ARK funds more to the next 40%, which is every year to six months to a year. You readjust those. You reallocate, you sell some winners, you take some losses, you tax advantage for those. If you're in a brokerage account, if you're in an IRA, you just reevaluate and readjust your portfolio. So again, 40% is you don't touch it, you just leave it. 40% is every 6 months to a year, you kind of readjust. And then the other 20% is split between 10% and 10%. 10% is 0 to 6 months. You swing trade those. You get in, you get out, you kind of move things around. The other 10% is completely day trading, or even, hold it for a couple of days, maybe a week. You can hold it for up to 6 months if you want. But it's something that you're not convicted to holding. Again, 40, 40, and then 10 and 10. Those are the four buckets that, in my opinion, you should manage your portfolio to. If you manage that portfolio to that, then your readjustment in that 40% could have been, essentially in the January timeframe, where some of these winners you could have taken some profits on. And then, readjusted and reallocated. When you saw the big downturn, you could adjust those. The 20% that you're looking at, the 10 and the 10, should have been in and out during these times of fluctuations, raising cash, making sure that you have the cash on hand to pull the trigger. So, with that said, wow, DraftKings was up 10% yesterday. It's up down 6% on the open. There are a lot. It looks like the ARK funds are down as much as 10%. There's a significant downturn on this stuff. So, again, that's kind of the play of the day. If you have any specific questions, ask me on Twitter. Reach out to me. Let me know. I'll take a look at some of the stocks. I think a lot of the charts are going to look ugly. I don't think that you're looking at a turnaround here. Again, this was kind of telegraphed. We knew it was going to happen. This was something that we should have been prepared for. Should have been making sure that our portfolios were solid. It is going to hurt. Even the best portfolio manager today is waking up. Nobody should have been 100% cash. The problem with 100% cash is you've got inflation. So you've got to look for those opportunities. With this amount of volatility, you should be in and out. Other than those names that you just don't get out of. You get into Apple, Microsoft, Google, energy names, Chevron, Exxon, even the XLE. If you wanted just a general, ETF, XLE. I think, again, in my mind, you're going back to 2013, 2014, which is, $100 on the XLE. You're at 67. Are you going to see fluctuations in this? It is totally oversold. Right now, the RSI on a weekly basis is at 67. So you've still probably got some movement to the downside, but with catalysts like this in Russia, yeah. Sorry to ramble on. I'll do better next time. Have a great day. Enjoy yourselves.